Welcome. In this video, will XCN coin price skyrocket? We will analyze it. Don't forget to subscribe, like, and please watch to the end to understand. When the chart structure is carefully examined, it becomes evident that the price has been in an upward trend for a considerable period, and that this trend has developed within a rising channel structure, one of the classic formations in technical analysis. This pattern is defined by two parallel upward-sloping trend lines. The lower band acts as support, while the upper band serves as resistance. An imaginary line running through the midpoint of the channel often acts as a guide in identifying temporary target levels and transition zones for the price. Currently, the price appears to have bounced upward after approaching the lower boundary of the channel, and this reactive movement could potentially continue toward the channel's midline, which is considered a strong technical possibility. The lower boundary of the channel is typically tested during periods of intense selling pressure. However, it often functions as a critical support zone where buyers re-enter the market and push the price higher. The current bounce illustrates that the lower region of the channel is still acting effectively and that the market is viewing it as a buying opportunity. Rising channel structures not only provide insights into the direction of the trend, but also help identify short-term trading targets. When a price reacts from the lower band, it is generally expected to first move toward the midline and then possibly to the upper band. In this context, the price's recent upward movement from the lower part of the channel makes it reasonable to consider the midline as the initial target in technical analysis. This zone may also have served as a resistance or support level in the past, which reinforces its importance not just in theory, but also in practice. Furthermore, price movements that develop within such channel formations tend to be volatile yet structurally disciplined. That is, while the price fluctuates up and down within the channel boundaries, its overall direction remains upward. During these fluctuations, technical indicators often provide confirming signals. For instance, the RSI may have approached the oversold zone when the price touched the lower boundary and could have signaled an upward reversal. This can be seen as another trigger supporting the upward move. Volume is also a key signal during bounces from the lower boundary of the channel. If the price rebounds from this support line with a noticeable increase in volume, it may indicate that buyers are becoming more active in the market and that the upward move could have continuation potential rather than being just a short-term reaction. On the other hand, low-volume bounces should be approached with caution. Reaching the midline is a significant milestone in technical analysis. This area may also represent a zone where short-term traders consider taking profits. If the price reaches this level and volume continues to increase while momentum is maintained, a further move toward the upper band of the channel may be expected. However, caution is warranted here, as the midline can act as both support and resistance, which means the price may consolidate or experience short-term corrections in this zone. Rising channels also offer investors an advantage in terms of risk management. Since both support and resistance levels are clearly defined, stop-loss levels can be set more easily. As long as the price does not fall below the lower band, the trend structure remains intact. This allows investors to maintain their positions based on a technical framework. The fact that the price is still moving within the channel indicates that the trend is still healthy and that buyers remain strong, but we can't base our analysis solely on the channel. Let's also take a look at other metrics. Stay tuned. When the overall chart structure is carefully examined, it is apparent that the price has been moving upward and is about to encounter a previously untested supply zone within the current market structure, technically referred to as a bearish order block. These types of zones are generally defined as areas where large sell orders accumulated in the past, where institutional players executed significant sell positions, and where the price reversed sharply downward. Therefore, when the price reaches such blocks for the first time, it is common for the area to act as a strong resistance. The concept of an order block arises from liquidity providers, namely institutional investors, placing large buy or sell orders in specific regions. A bearish order block is a downward-leaning structure typically formed by candle blocks where strong selling previously occurred, followed by a sharp price drop. These blocks are often seen as selling opportunities by many traders because they usually contain large volumes of pending sell orders. When the price reaches these areas, selling pressure may increase, potentially limiting upward momentum. In the current scenario, the fact that the price is about to encounter this bearish order block for the first time is particularly critical. This is because such blocks are rarely broken on the first attempt. According to technical analysis principles, resistance zones like this typically require multiple tests before being breached. The initial contact is important as it reveals the extent of selling pressure the market faces. Buyers are tested at this level, and if sufficient volume and momentum are not present, the price will often retrace from this zone. These pullbacks should generally be interpreted as healthy corrective movements, as the market rarely continues upward in a straight line. Especially during the first encounters with strong resistance zones, such retracements reflect profit-taking behavior and shifts in market psychology. The price reaction at this level will offer important clues as to whether the price can eventually break through the zone. If the price recovers after a pullback and approaches the level again, it indicates that buyers remain active and the upward momentum persists despite selling pressure. One of the most crucial elements for breaking through bearish order blocks is trading volume. If volume is low when the price approaches this area, it often suggests insufficient buying power and that the zone is not yet ready to be breached. However, if trading volume increases significantly as the price approaches the area again, it indicates that buyers are regrouping and gaining strength to push through the resistance. Therefore, traders should pay attention not only to price levels, but also to the volume dynamics at those levels. Breaking through bearish order blocks is often not just a technical breakout. It also represents a psychological threshold. Since significant selling pressure was previously encountered in these areas, they remain mentally marked as unsafe zones for many investors. Overcoming this psychological barrier is not only a matter of technical analysis, but also involves investor behavior. Consequently, once the price breaks through such a zone, rapid and strong upward movements are often observed. Many investors regain confidence after the breakout and increase their positions. In addition, this breakout may trigger stop orders. Since the stop-loss levels of bears holding positions at this level are often placed just above the zone, sharp and sudden upward movements can occur after the breakout. On the other hand, a potential rejection following the initial contact with this zone can also present new opportunities for traders, especially for those looking to take short-term short positions. The first reaction from this block is valuable. The 200-period exponential moving average, which is frequently used in technical analysis and is considered by traders as an important reference point in evaluating market trends, stands out as a critical level that is currently in direct contact with price action. This indicator, which is a very powerful tool for detecting the direction of long-term trends and generating signals about the general trend of the market, is watched with great attention by both individual investors and professional traders. This is because the 200 EMA often serves as a decisive boundary as to whether the trend will continue or signal a possible reversal. In the current situation, the fact that the price has approached and even touched this long-term average suggests that we are at a very sensitive technical threshold. Such contacts have played an important role in changing the direction of the price or strengthening the current trend many times in the past. This is because the 200 EMA acts as a trend filter. If the price manages to cross this level from the bottom to the top, it usually signals a change in the general tendency of market participants and that buyers are beginning to take control. 200 EMA shows long-term trends. Yes, friends, I hope you liked the video. If you subscribe to my channel and like the video, more videos will be coming. Be careful in your investments, analyze the risks correctly, and always take strategic steps. I will be with you with different analyses, investment opportunities, and technical information in my videos. I wish you all a lot of profit. See you soon.